In this video, we're going to continue with our example of property, plant, and equipment, but this time we're going to look at the change in the accumulated depreciation account. In the statement of cash flow, specifically in the operating activities section, we need to add back the depreciation expense that was recorded during the year. That expense is included in net income, but it's not a cash expense, and so adding it back removes it from the operating activities section. Now, when a company records depreciation expense, that makes the accumulated depreciation account go up during the year. And you can see in this journal entry, we debit the expense and we credit the accumulated depreciation. But that's not the only thing that's happening in this account. So up here, back to our balance sheet, we can see that over the course of the year, from the end of 18 to the end of 19, there was a $1,000 increase in accumulated depreciation. That would have part of that increase would have been caused by the recording of depreciation expense. But we have to be careful not to assume that that is the only thing that happened in the accumulated depreciation account. And so back to our example on the equipment, they sold equipment during the year that cost $1,000. It had a book value of $400 and a cash sale price of $600. When they sold this equipment, they would have removed the cost. They would have removed the accumulated depreciation from the books, recorded their sale price and cash coming in, and then they also, in this case, they would have recorded a gain on the sale because the cash sale price is $200 greater than the book value. Now let's look at this just for 1 second here. What is book value? Book value is the difference between cost and accumulated depreciation. So if you have a cost of $1,000 and a book value of $400, you must have accumulated depreciation on this equipment of $600. And if that's the case, as a result, that's the difference between these two numbers here, that when they recorded this sale, they would have removed that accumulated depreciation from the books. So let's go ahead and do that here. Let's record this sale. And that would look like this. They would have debited cash for $600. They would have debited that accumulated depreciation to remove it from the books, also for $600. They would have credited the equipment account for $1,000 to take it off the books. And they had a resulting gain on the sale. We can see a gain here of $200, and our debits equal our credits. So in the accumulated depreciation account, two things are happening. First, they are recording depreciation expense during the year, and second, they are also removing accumulated depreciation for any accounts or any depreciable assets that were sold. If we take this into the accumulated depreciation account and we look at the ledger account, let's make a ledger T account here, and we've got accumulated depreciation. This is a contra asset, and so its balances are going to be on the right hand side. It goes up on the right. It's got a beginning balance of $3,000. It's got an ending balance of $4,000. That's beginning, that's ending. And we know that they removed $600 of accumulated depreciation during the year for assets that were sold. And if that's the case, how much depreciation expense was recorded? They must have recorded $1,600 of depreciation expense. And so instead of simply just the difference between these two accounts, they did not record $1,000 of depreciation expense. They actually recorded $1,600. This is what's in net income, and this is what needs to get added back in the operating activities section of the statement of cash flows. So accumulated depreciation, this is a balance sheet account, but because it works with the depreciation expense account, we can use changes in this account. We can analyze it to figure out what this depreciation expense would have been during the period.